Greetings, Jonathan Camarda, Chief Investment Officer, with your weekly macro update. So let's get right to it. A lot of economic data, and then we'll filter that into the market and what that means for your portfolio. It's a lot to cover here, so let's get rolling. All right. So first thing, economically, obviously, financial sector, regional banks, more specifically, been under a lot of pressure. You don't need me to tell you that. So let's get into a little granularity. The Fed has kicked in. We're talking about 200 trillion with a T. And the saving of some of these banks and as such, almost acting as quantitative easing to go along with the quantitative tightening. So it really is just a cluster right now. We'll get to the Fed meeting as well. Now, of course, First Republic got saved by the banks themselves coming in with 30 billion with a B, and as such there. So a lot of money going into some triage here. Now, just over the weekend, we had UBS came in and white knighted Credit Suisse, what many economists are calling, obviously, a bailout, de facto bailout, and as such as, again, the dominoes fall. Now, a lot of folks saying this isn't 2008 from that standpoint, but obviously a lot of risk management issues here across the board, many different symptoms that have caused this. In Europe, they're saying that, Credit Suisse was they're blaming some of the U.S. banks. A lot of this is mutually exclusive. However, this is what happens when the tide starts to rise, or in this case, the rates, right? So let's get also to some other data maybe of interest to you. Mortgage rate, 7.1%, okay, to buy a house. Housing, obviously, under a lot of pressure. That's an attractive rate, right? Obviously, facetious there. Now, when you start to look at credit card debt, it's at 985 billion. Again, I memorize all these stats, folks, to save time. I'm not reading off of a screen and, sitting there drinking my coffee and such. So this is very focused. So again, I might be off by a little bit, but very, very small standard deviation of error here on my numbers, as my memory is still pretty good last I checked. So just under $1 trillion on credit card debt. Now, that's only up 20% over the last 15 years. So it is a big headline number, but the rise in the last 15 years, maybe not as alarming as some folks make it, although the number is large. Now, as we also go now, we talked about the employment data and some of the puffery the last few weeks and as such. But if you look at year to date in the tech sector, over 300,000 layoffs. Okay, your Metas, your Microsofts, your Amazons, your Salesforce. Some may say that was long overdue for them, and as such, along with Meta, I suppose. So again, that's a leading indicator. And so that was already portending recession, right? Like even late last year when these tech companies started laying people off. Those numbers don't include last year's. Meanwhile, the economic data, when you look at the jobs reports, 517 off the seasonally inflated January, mostly part-time jobs. We've already covered all of that. So now let's get to where we are from an economic standpoint. So one thing I want to do is a little house cleaning from last week, as I unfairly blamed Uncle Jerry, really, for the SVB. And of course, rising rates is a culprit. That's like going to Alaska, getting in a cabin, and the tour guide says, hey, watch out for the grizzlies and the wolves, and you step out with your cup of coffee unwittingly, and you get eaten. Well, sure, it was the bear that ate you, but you have to be aware of your surroundings. Metaphorically, what I'm saying is that, yes, rates were rising, but here's the deal. The Fed actually warned SVB back in 2019, a few years ago, that their risk management was way off. And here's a scenario. It's what they call, and I'll try to make this as benign as possible, as easy, palatable as possible. So again, they had mismatching liabilities, right? So their liabilities to depositors, short term, right? Give me my money now. We've heard those lines in movies. But their assets were what they call long duration, longer term, and long-term bonds. So many newspapers have glossed over this saying, well, yeah, but they weren't risky like some of these mortgages back in '08. No, they were U.S. Treasuries. However, long-term Treasuries have an inverse effect with interest rates. So as the Fed was raising last year in rates, right, their bond principal was going down, and the value rather. And so what happens then is that when you have a run on a bank and people want their money, you don't have the balance sheet levels that you did because of the rising rates. But most banks, what they do is risk manage this, and I'll make this as simple as I possibly can on a Monday morning, is using what they call credit default swaps. And so what generally a bank would do is, because they have these longer duration assets, these long-term treasuries, they would pay in a swap, like baseball cards as a kid, right? They would pay, the fixed income, because they were already getting that from the long-term treasuries, and they would receive variable rates. That's the swap. So as rates go up, they would be receiving these variable rates to counter that loss on their balance sheet of the long-term treasuries, and therefore, if they had depositors wanting their assets that would what they call shorten the duration of their long-term assets to be able to furnish these depositors' requests. Easy for me to say. My whole point is that SVB didn't have a chief risk officer until 2022, although they were busy doing a lot of corporate events and certainly a lot of other little things they were doing to feel good about themselves. The risk management was way off. San Francisco Fed overlooks that. No comment from them. I'm going to leave that at that. So again, yes, the Fed raised rates, but that's just the environment. Risk management, that's on the bank. Now, as we get to the Fed, great segue. What will they do this week? Well, it was looking 50 basis points a few weeks ago with all this puffery in the economic data, but some of those numbers have been softening coming into this bank debacle, and so 25 basis points now is looked at as only, so you don't scare the system like, oh, they can't even raise that much because things are that bad. Confidence boost, I think 25 is the consensus, although 0 by many in the know, saying that's really what they need to do. They need to just stop and no forward guidance. All right, don't tell us what you think, Jerry. No dot plots. Just say, hey, we're going to monitor this situation very closely and eye this thing up, okay, like a 3-foot putt to win the Masters. But we'll see what Jerry does this week. 25 is the consensus for the confidence vote. We'll see. What does that mean for markets? So let's just unwind that. Well, obviously the KBW, the regional bank index, is down over 30% over the last 9 trading days. No surprise there. The small cap Russell 2000 is down pretty heavy. It was up 14%, just six over the last 6 weeks. It went up 14% for the year to negative for the year. Easy for me to say. Again, just give me a little bit of looseness there, since I just have these in the old noggin. Now, here's the deal: technologies versus the S&P 500 has acted at the most widest gap of outperformance since 2008. So I don't know what that says, if that's poetic or not, but here's the deal. Technologies and semiconductors, okay, have been outperforming recently. You say, well, why is that in a volatile environment? Because the risks this year have changed. So last year you had a rising dollar, rising rates. Now you have more of a docile dollar, and rates are going down because, again, the bond market already sees it. They're playing 3D zero graph chess. Well, the Fed and all these pundits are really playing checkers. I hate to say it like that. And what happens is that with declining rates, we were buying a lot of these treasuries, especially the most conservative strategies, late last year, sniffing this thing out. And so this year, with rates going down, growth companies, which have smashed value companies over the last couple of weeks, doesn't make sense intuitively, but it does if you start to look inside the numbers, inside baseball, as they say, because declining rates in the denominator of a lot of these growth, when they start to do what they call cash flow modeling, that increases your outcome, right? Math 101, Division 101. And so essentially that's why growth companies have been outperforming. So you'll see in some of your strategies like Velocity Raptor, where we reduce the energy and industrial exposure and increase tech and semiconductor exposure. That was the reason. Some of your strategies like Global Macro, which we've hedged over the last couple of weeks, but have also remained pretty steadfast in our semiconductor and technology exposure. That's working out pretty decently as a hedge. And then also in your active capital preservation, you may have noticed that, again, we decreased, basically industrial metals and energy exposure, really more in favor of gold and short-term and long-term treasuries. Short end of the curve, looking really good. Long end of the curve, we have very little exposure in the middle of the curve, which we don't like as much. And then, of course, your cash, which is a high percentage of your macro and sector momentum. That would be not really cash, right? It's the SNOCs, your Federal Reserve's Treasury Obligation Repurchase Agreement fund, paying, I think, just under 4.3% at the end of last week. So what does all this mean? High caution, right? We're being very cautious going in to see what the Fed does here. There's a lot of landmines around, and yet pockets of opportunity, especially in some of the growth sectors, right? And that's the true beauty of the situation. The script is flipped from last year on what is working. Last year it was value, right? Your industrials and the such. But this year, right now, growth, at least in this pocket, is outperforming. Now, that's not to say that we have to be extremely cautious and maybe continue to hedge if this overall macro bear market takes a next leg down. So we do not obscure that, obviously, as a potentially likely scenario. So this isn't a typical year in a such where you have had some positive moves in the indices. There's a lot of cracking under the ice, so to speak, from that standpoint. So to summarize all of it, again, we'll stay on top of this and watch to see what the Fed does this week. Very interesting. Keep our head on a swivel and nimbly maneuver. If you have any questions on your strategy, just let your personal wealth advisor know. And then, of course, they can get to the idiosyncrasies of what your risk exposure is. Now, the last strategy that I will mention is opportunistic growth and income, which is more of our value dividend stock portfolio. That is based more on fundamentals and less on trends. Thus, that has remained exposure in a lot of the dividend-paying stocks and some of the energy complex, although, again, as we start to look at some of these tricklings through to the fundamental factors, those changes will be made as well. Last point I'll make, gold. Gold is going higher, so it's breaking through some of its 2012 levels. And again, gold was a hero along with treasuries during the 2008 meltdown. Potentially, you could see that tandem working as well as we've increased exposure there as well. That's all I have for now. We appreciate your time, patience, and as always, your trust. Until next time, Jonathan Camarda, stay frosty out there. Easily said for us. Take it easy.